Congratulations for making the right choice and joining the new normal of virtual training. I am Jeff Kidwell and welcome to Finance Academy's Repo 101 course. If Repo 101 is not your final destination, you may wish to go back to the main menu now. While repo is generally considered part of securities financing, along with securities lending, the Securities Lending 101 course and the Repo 101 course at Finance Academy are taught separately, should be viewed as two distinct courses, and there should be only a few minor topic overlaps, but from different instructors and different perspectives. I will be your instructor for Repo 101, and this is Lesson 1. I have designed and written the slides and lectures for this Repo 101 course in 11 lessons. Each lesson can be accessed individually from the other lessons so that each lesson is a standalone. This enables the participant, that would be you, to choose which lessons they would like to attend or allow the participant to go back over important information. Even though the lessons are independent, they follow a logical progression of the participant's understanding, building on previous lessons' topic complexity. Each lesson will have an introduction of what to expect for that particular lesson at the beginning, and a recap of that particular lesson at the end. Lesson 11 will have summaries of the other 10 lessons, as well as an exam and a preview of what's to come in Repo 201. Did I mention that the entire course will be in American English? That does not mean that this course will be US-centric. It is intended to apply globally and include international repo topics. Each lesson should take about 1 hour, give or take 15 minutes, plus any tangents by the instructor. So buckle up, it could be a bumpy ride. So we've gone over the high-level curriculum of this lesson, and now we get to the awkward stage. I believe that many of you are expecting or hoping for a college professor or a regulator as your repo instructor. However, Finance Academy wanted to give you the best chance for success. Nothing against professors or our esteemed regulators, by choosing working experts in the field of various core subjects, including Repo 101. I have lived the things I will be teaching you and have walked the walk and talked the talk. Okay, this is the awkward part, to talk about oneself. Don't worry, none of this will be on the exam, but I know you want to know my bona fides. As I said, my name is Jeff Kidwell, although many colleagues have referred to me as Elvis, and many of you have likely heard of me already for one reason or another. I have been in the repo and securities lending business from 3 or 4 perspectives since 1982, after I graduated from Cornell University with a BA in English and minors in business and journalism. I started at a large primary dealer, Morgan Stanley, where I worked up the ranks in repo and securities lending trading after a brief stint in information technology, to become an executive director and head of the Repo and Securities Lending Division for the U.S. and Canada, and head of municipal financing. I was also for a time responsible for managing and forming the Morgan Stanley European Repo Division in London, and was a member of the European Repo Council and overseeing the Asian Repo Desk in Tokyo. While at Morgan Stanley, I was very involved in a very early fintech solution, RepoLink, which I started on Bloomberg's platform. Also while at Morgan Stanley, I began a long term on the SIFMA Financing Executive Committee. SIFMA was PSA and then BMA before that. I also began writing my infamous daily repo commentary at Morgan Stanley in 1983 and distributed it to thousands of clients and internally. In 2004, I moved to Cantor Fitzgerald, who had been ravaged by the terrible 9/11 terrorist attacks, killing about 80% of its U.S. workforce and wiping out the then existing repo desk. I was hired as a managing director and global co-head of the Repo and Securities Lending Division, empowered to fast-track Cantor Fitzgerald into a small primary dealer in just 4 months. As my style was to develop and manage repo and securities lending relationships throughout my career, even though I was a trader, my partner and I split responsibilities, and I focused on being head of the sales half of the repo division, and he focused on the trading half. While at Cantor, I was part of a task force to help create the mortgage-backed component of BrokerTech, was part of the Federal Reserve's Y2K task force, among other Fed, SIA, and SIFMA task forces, and was there at the creation of Helix. While at Cantor, I was also very involved in another fintech solution, Cantor Fits, which was web-based. I also continued writing my daily repo commentary while at Cantor, and the distribution grew. At the beginning of 2008, I left How did that get in here? Okay, we'll explain that later. At the beginning of 2008, I left Cantor and New York City and joined a small introducing non-primary broker-dealer, basically a broker, AVM LP, affiliated with the buy-side hedge fund III Associates as a director in Boca Raton, Florida, as I had moved to Palm Beach Gardens, Florida. I was hired at AVM to help finance the hedge fund and the broker-dealer, building a business of buy-side clients. I was head of the repo and securities lending sales efforts at AVM's repo division. When I began at AVM, I had the idea to start connecting my thousands of buy-side clients, cash providers, with the collateral providers, and originated a product I called Direct Repo, which is essentially peer-to-peer repo financing. I know a lot of this is going to sound ancient Egyptian to many of you, but you'll have the chance to learn all about this in Repo 101 and Repo 201. So at AVM, the fintech solution I started there, connected with Direct Repo, was web-based Direct Repo Live, DRX. And of course, while at AVM, I continued writing my repo commentary, although only 2 or 3 times per week. But now the distribution had become massive and was going out to state treasurers, most CEOs, CFOs, CIOs, and the like. Since 2018, I've been consulting, focusing on chairing and moderating several repo and securities lending industry conferences, writing many articles for industry periodicals, working on a fintech solution for peer-to-peer securities financing, and I published a book as a ghostwriter. And yes, I still write the repo commentary, although more like every 2 weeks now. You can see it for free on LinkedIn and on the website that I have on the screen, www.repocommentary.com. I warn you ahead of time that it has about 35 funny pictures and is about 70% entertainment and 30% actual business news, which is probably why it's still popular. Throughout my long career, I've been a frequent speaker, moderator, chair, industry expert at repo and securities lending conferences. I've been a frequent contributor or interviewee for industry periodicals and national publications, as well as author of the 70-page 2014 white paper, Regulatory Reform, Potential Impact on the Repo Market. More relevant to you, though, I have trained hundreds of repo and securities lending personnel globally at the firms I worked at several client firms, and instructed at repo schools at my firms as well as BMA, SIFMA, and SIA. I like to think that throughout my career, I also have had a special relationship with the Federal Reserve and the U.S. Treasury. So let me answer that second question that you may have had. When I said I had 3 or 4 perspectives in my career, I meant as an employee of a large primary dealer, sell side, in growing a small primary dealer from infancy, still sell side, as an employee of an introducing broker-dealer, so a broker side, and at a hedge fund, which is a buy side. I would think that I also have a fintech vendor perspective as well after all of my technology projects. I think it's unusual for anyone in our business to have perspectives from so many angles. Okay, I guess the third question you may have had was, what about the Elvis thing? All right. In addition to writing the repo commentary over the years, I have also sung at various industry events as an Elvis tribute artist or as myself. I became an ETA in 1989 after a dare from then Morgan Stanley president John Mack. The Wall Street Journal referred to me as a Renaissance trader in a 2006 feature article. Since 2003, I have also had the honor to sing the national anthem at 153 Major League Baseball games at all levels. I am a professional singer in Florida. Okay, enough about me. Let's talk about you. Actually, I hope I have the privilege to meet you someday. With all of my different vantage points on the industry and experience, I should be able to touch on subjects that will impact your function at all kinds of different institutions. And the best thing about it is that I have been updating my knowledge every day, essential not only for this repo course, but also to frequently update my repo commentary. We're going to cover the major topics of repo, from the basics to the more advanced. You should learn the highlights of the repo history in this lesson, along with the basic terminology, which, by the way, is the hardest part about repo, and still difficult for some people in it 10 years, and a little bit about data. In the following lesson, you will learn about repo and the life cycle of a repo trade. Then in lesson 3, you will learn about reverse repo, the other side, and the life cycle of that trade. Lesson 4 dives into the difference between general collateral and specials, while Lesson 5 takes you deep into cash providers and collateral providers, another topic that is basic yet seems to get lost in the shuffle among many seasoned veterans and the media. I know I said there would be no math on this course or test, but Lesson 6 will provide you with a few basic formulas you need, and we'll dive into the haircut debate and dive deep into other repo and reverse repo trade terms. I consider Lesson 7 the big jump, as we move from the basics of repo to repo matchbooks, broker-dealers, and I know a little bit about regulations. It won't be all of the regulations, I promise you. In fact, I just checked, and out of 370 plus regulations, it will only touch on, and not deeply, about 17 regulations. Lesson 8 will really take you into the trading of repo, focusing on the major risks and the way to mitigate those risks. Lesson 9 is even more intense as I go through the popular repo trading strategies that I have used and are generally used in the industry. Yes, normally you don't hear about trading strategies from anyone or at any conference. It's very hard to corner somebody and get their deepest, darkest secrets about trading, and everybody thinks that they have the only ideas. But I am just going to pull the curtain back a little and show you what I have learned. I will have tons of disclaimers for that lesson, of course. Past performance is no guarantee of future performance. These are my opinions or general industry opinions. There's no guarantees, yada, yada, yada. If I were a betting man, I would bet that this chapter is the one most likely to be skipped to or singled out by some participants. Lesson 10 will be about the largest repo market player, the Federal Reserve, who currently has about a $4 trillion repo book, and will give you some of my feelings and information I have learned from the Fed and the U.S. Treasury. In Lesson 11, assuming you are still with me, I will summarize each of the lessons, but will definitely avoid any of the material that will help you on the exam. Then there's the exam, and then I'll give you a preview of what to expect from Repo 201 once we finish that. I will be imparting almost 4 decades of repo experience to you, powered by years of research, practical real-life experience and stories, and even years of teaching others about repo. We will also have attachments to this Repo 101 course. There are 2 of them. There is my white paper on hundreds of regulatory reforms and the impact on various sectors of the repo and securities lending market. I've been meaning to write a securities financing book, but I've just not waded into that pool yet. There was a book by Marcia Stigum, probably out of print, but you can look for it, and it was titled Repo and Reverse Repo Market, and coincidentally, it included information from interviewing me and Bob Diamond and others in the 1980s. Going back to that slide that seems like it was ages ago that showed the 4 things on a list and coming in, the last one was resources. Regarding resources, beyond these 11 PowerPoint lessons for Repo 101, I also have my white paper and repo commentary available, as I said. I have included 2 attachments to Repo 101. The first being the glossary of acronyms, which should help you going forward, and alternative repo and alternatives to repo, which should be interesting for those with a little bit more knowledge. I believe there will also be additional resources available from Finance Academy, and I may also be available for interactive sessions, likely using Zoom. Since this particular virtual training or distance learning is not currently interactive, I thought I would show you that picture of me, the one that you have in front of me with me smirking, in case we run into each other. So you can recognize me and give me the pleasure of meeting you. Although Repo 101 is heavy with PowerPoint slides, which I have made fun, I may make some surprise video appearances between slides to shake it up a little. Oh, and full disclosure, anything I say or show you after this point is fair game for the exam in Lesson 11. So hopefully you enjoy, and hopefully you learn a lot. This is almost an obligatory slide when teaching repo. That's a tow truck, if you're wondering, or what some of us may call a wrecker. Let's take care of this business right now. First of all, as you may know, repo is one of the most difficult products to understand in all of money markets. While that's mostly because of the structure of the trades being foreign to the public, at least until there's a major crisis, when repo suddenly winds up on national news and newspaper front pages, it is also because of the odd nomenclature that is confusing and strange to most people. We're going to delve deep into nomenclature throughout the course, but in particular in this lesson a little later. Also, don't forget that you have an attachment or addendum after Lesson 11 with a very complete glossary of acronyms, which should be helpful. Anyway, when I am at a dinner party or Thanksgiving dinner or even on the phone with my mom, invariably someone asks what I do and then asks what repo is. Most of those people, even still my mom and several close friends, have the tow truck pictured in their minds, hauling off some poor guy or woman's car for non-payment. There was even a fairly popular movie called Repo Man, which was about the same tow truck subject of repossession. That is not what I have done for over 38 years, Mom. I've never even driven a tow truck or a wrecker. We are here to learn all about repurchase agreements, which stands not only for the trade, but also is the document used to execute the trade. I see that repurchase agreements would be a mouthful to say, but I have no idea how it became shortened to repo. And calling this sector of the market repo is still not fully accurate. We are perpetuating the use of a shortened generic name for something that covers many other products besides repo agreements, even products that are in the opposite direction, and we'll explore that in a bit. Before we watch the tow truck drive off for his next call, I virtually see a hand raised, as someone doesn't want to let the etymology of the word repo go. She points out that the tow truck is repossessing a vehicle on behalf of the real owner because of default by the lessee or buyer to the bank. While a default on a repurchase agreement can lead to a repossession of collateral sold or lent by the true owner, the trade itself is completely different. Repo, and for the most part all of securities financing, has had a quiet existence, rapidly growing and becoming profitable, but staying below the radar. But as you will see in the next two slides, it has popped up now and again in mainstream media, and usually not in a positive way. Frequently it has been made out to be the villain, when actually other forces were at play. But those rare incidents aside, repo has grown as an integral part of capital markets, particularly at broker-dealers, but also at many sectors of customers as well as central banks. It not only has provided liquidity to those institutions that are long securities or want to buy securities, but also liquidity to those institutions that are short securities or want to sell securities. While having become a formidable profit center itself, making sometimes hundreds of millions of dollars per year, it has also facilitated other capital markets within firms, including equities, corporates, mortgage-backs, treasuries, governments, swaps, foreign exchange, municipals, high yield, etc. Repo also helps issuers of securities, particularly central banks and governments, to place those securities and provide liquidity for their purchases. Repo is even used by those central banks themselves to manage their own monetary policy and manage the liquidity in their respective markets and currency. So even if the media has infrequently said that repo is a four-letter word, it plays an essential role in the functioning of the financial markets. When I started in 1982, I heard that repo had begun in the 1970s, involving U.S. Treasury securities, and wouldn't hit Europe until years later. Still, securities lending, an earlier stock loan, was the predecessor to repo. The clearing and custody guys in the back office, as we called it, where there was an actual cage and a vault and a cashier, would speak with their buddies at other brokerage firms who needed certain bonds to make deliveries, and they would lend to each other. And remember, back then, equities and bonds were paper, that was physically delivered by runners who sometimes detoured to the Killarney Rows or other such bars down on Wall Street, which caused some fails of securities. These were frequently coupon-bearing instruments that were very important documents. If a custodian or clearing area was short to make the delivery, they would need to borrow from one of their peers. The back-office functionality of this stock loan eventually split off from the rest of custody and clearing services and became its own area. I remember when I started that there was still a Morgan Stanley Special Services division downtown near the clearing area. I think it was MSSSI. Eventually, only a little before I started, the stock loan area and the bond lending people moved uptown to the midtown offices, facilitating the capital markets, trading departments, and occasionally customers. When Repo was finally noticed by the other departments as an actual profit center, there were several takeover attempts by several different departments within the broker-dealers. If a repo desk was predominantly funding the firm, sometimes the corporate treasury department, which did funding for other parts of the firm through commercial paper issuance, such as M&A activity, laid claim to the repo area. In other firms, where the repo desk was predominantly financing U.S. treasuries, both the swaps area and the government's area would battle for control of the repo area. Eventually, securities financing made enough money on its own that it became its own department within fixed income and within equities, and sometimes also within municipal bonds. That transition to its own profit center was not a painless one, as there were still turf battles, arguments about prioritizing one department over another, and some repo departments charging other departments for funding them. Ironically, now that hundreds of regulations have descended on broker-dealers, capital markets, and repo, there have been moves by some banks to actually move repo departments into new balance sheet optimization groups or liquidity and asset management groups. Repo is now the largest part of every broker-dealer balance sheet, so it makes sense, given the regulatory framework, to try to manage that firm-wide context. By the way, I want to apologize if there's a noise in the background that you hear. That's actually through the wall coming from like a 40-mile-an-hour wind off the balcony. Apparently we were in some minor tropical storm. Anyway, this next slide is going to be a little bit scary. I'm sure that most of your history lessons in school began with the beginning of a culture, an epoch, an era, or a significant event, and then your course expanded from there. Repo history is, in relation, very short, even with my 38 years in the industry, but the innovations, or evolution, if you will, has been great. It is not easy to mark the passage of time or the evolution by looking at all the innovations. Sometimes it's easier to look at the events. When I arrived on the repo desk at Morgan Stanley, I was one of 6 traders. There was no dedicated sales force. There were some salespeople in money markets, corporates, governments, equities, and swaps that had clients who were interested in repo. I sat at a desk right on top of the people on either side of me with a Monroe bond calculator, a phone, and a legal pad. My predecessor, as I mentioned, spent the morning telling me how to call the back office to check the box and find out what securities I would need to finance that day. And I would write them down on the legal pad, leaving space under each security to write in the trades that I did, or another repo trader did, or bond trader did on that security, so that I could get the grand total on each security down to 0 by the end of the day. Then the guy went off to see the U.S. Open tennis tournament and left me with all my unanswered questions. Although I had had some formal securities training while in the MIS department, which at that time was IT at Morgan Stanley, and would have more in getting my Series 7 and 63, it did not prepare me for who to call, how to trade, and how to make everything balance, particularly while other actions by other traders and salespeople affected those same positions. There were no computers or computer reports. There were paper trade tickets with carbon between to create them in 5 copies for P&S, clearing, trading, books and records, etc. Somehow, without a virtual training course or distance learning like this, I managed to survive. It was an exciting time when I started. We did not have computers, but I had just helped install Davoxes on desks, which were simple machines with function keys that allowed personnel to print specific reports or see a static screen. We also were becoming familiar with something called a squawk box, or white phone, although they were usually beige, which was a sort of intercom or walkie-talkie between salespeople and traders. We were also just learning about over-the-top speakers in the ceiling from which branch offices could yell orders. Within a year, we were just starting to do tri-party repo. In fact, two of my customers, and I suppose I, were some of the first people to trade the new product, which you will learn about later. And our desks were just beginning to shrink even further, with mounting broker screens, Bloombergs, and calculators taking up precious room. Next, computers would arrive in their simplest forms, which are gigantic. So you see, we were small, the market was small, it wasn't long ago, but the innovation leaps were quick. However, landmark incidents were infrequent and usually involved something that the general industry hadn't thought about before or how to prevent. So those mistakes or upheavals led to industry knowledge and new legislations and regulations, most of which were necessary. And you will see how important the positives or evolutionary steps were that came from those incidents. While I was writing down positions on my legal pad with a pencil to erase any mistakes I made, while I was busy writing down those positions on my legal pad, something called Lombard wall was coming to light. I was buried in trying to get each security down to zero, or up to zero, by the end of the trading session, which could be 2:30, 3, 3:30, 4, or even 7, depending on how long the wire stayed open, and that's the Fed wire, and it was actually decided by the Federal Reserve, to pay much attention to something that involved the concept of secured loans versus sale and repurchase and the bankruptcy automatic stay provision. It turns out that all of those things were part of a landmark case for the securities financing industry, as I certainly came to realize months later. The court ruled that repo was not a secured loan, but was a security transaction or trade, one in which one party sold to another and agreed to purchase the securities back in the future. So it was a sale and a buy. The court also said that although filing bankruptcy typically provides a 30-day stay from attacks from creditors on the debtor, while the court and trustee sort things out, the repurchase agreement was a security transaction and a contract and was exempt from the bankruptcy stay. This was huge for the repo market, not only because that meant that the remedies in the repurchase agreement for both counterparties, if the other defaulted, were still intact, but also because both parties weren't subject to additional market risk of having to wait 30 days to liquidate the securities to make themselves whole. This will come up again in our discussion later. In the same year, ironically, when I started, another case became famous, Drysdale Securities. Perhaps you've heard of it. I don't know if it was because of the public's fascination with the banker Miss Drysdale of the popular TV sitcom Beverly Hillbillies at the time, or because of the amount of money involved was huge. Basically, this case revolved around how to price securities for repo transactions, and whether the coupon interest, which would accrue during the trade, was the property of the owner of the security or the one who the security was lent or repoed to. In fact, it also involved the accrued coupon interest prior to the repo transaction, which had yet to be paid by the issuer. The court ruled that the coupon interest on the bond used in a repo was due the owner of the security, and therefore was also part of the price of the security at the beginning of the repo transaction, not an extra profit that the company would withhold, like Drysdale Securities did. What's interesting about this is this also created something much further on that the Federal Reserve did to track repo interest in repo transactions to make sure that the owner of the security would actually get paid their coupon interest. I'm sure you're following the timeline, so you know that next, in 1985, the Bevel-Bressler case demonstrated custodial risk and the need to have control or possession of the securities during a repo transaction. It was later referred to as a perfected security interest in those securities. I recall that the case also involved some duplication of repo trades and the move to create insurance for brokerage trades under what we call now SIPC, SIPC. You look that up in the acronym addendum. In 1989, Finance Corporation of America hit the headlines as the first of a long string of dominoes of failing savings and loans or thrift institutions during the thrift crisis. Many of these banks, thrifts, went bankrupt and many had to consolidate. The factors were the amount of leverage used, the lending policies, and the difficulty in liquidation of their securities. I see through my virtual screen a hand up from one of the regulators in the audience who wants to point out that too much leverage has frequently been a problem for the repo industry, as you will see just in this short history of the repo industry. In 1994, Orange County, California, a municipality, shocked the world by announcing its bankruptcy. As the case unfolded and broker-dealers took large losses, we found that the broker-dealers and some people at the municipality had overlooked the investment policies of that municipality and had somehow invested in derivative securities and had used too much leverage. Here's a second instance of it. Also in 1994, and actually just a few desks over from me, Askin Capital showed up in the press for having invested in principal-only strips and for fighting the liquidation process, which they lost. We're still in the banner year of 1994 as Kidder Peabody made national headlines with huge losses, which it never recovered from, partly due to complex interest-only, principal-only securities, huge leverage, nearly triple digits, and the illegal practices of one rogue trader, Joe Jett. He had amassed a huge position of illiquid collateral without most people knowing, hiding the positions. Ironically, when he first started in the business, he was in the department about 20 feet from my desk. Arguably, the second most famous incident on this list in these two slides happened in 1998 when Long-Term Capital Management, a huge hedge fund, defaulted on its repos to the street after having made some bad currency bets. Since the broker-dealers whom LTCM had repoed securities to didn't actually speak to each other, after all, there were 46 primary dealers back then, as opposed to the 22 now, and they were competitors. Trade information like that was confidential, and laws actually to protect the customer's information prevented those broker-dealers from divulging trading activity from a customer to another broker-dealer. So as huge and valued customer LTCM approached dealer 1, and you can substitute any dealer name of the time in this example, as in the end, 16 of them were involved. So as LTCM approached dealer 1 to do a large repo, it also approached dealer 2, dealer 3, dealer 4, etc. to do similarly large repos. In the end, authors and experts have estimated that leverage employed may have been as high as 200 to 1, and that the 16 dealers each may have had 10 to 20 billion in repo trades on with the LTCM. Let's call too much leverage, problem 1. Still keeps coming up, right? Too much leverage, because we still, at this point, haven't been learning from it. Problem 2 was the nature of LTCM's relationship with each of these broker-dealers, who, in a vacuum, saw LTCM as one of their largest and most important clients, trading billions of dollars in repo and in swaps and maybe other outright securities. Accordingly, they offered them incentives and premium status. They became platinum accounts, maybe with smaller initial margin requirements or longer terms for trades or less liquid collateral for trades. That led to problem 3, which was a client doing many different products with one broker-dealer, but with that dealer having no way of using that to protect itself. These products didn't net exposure against each other. They were treated separately. So a gain in one couldn't offset the loss in another. After this incident, this would be addressed with cross-netting agreements. But we'll get to that. Problem 4 was a whole new problem that the street didn't see coming. Much of the collateral that LTCM had bought on leverage was U.S. Treasury securities, backed by the full faith of the U.S. government and very highly liquid, trading in billions of dollars each day. So, since they were purchased on leverage, the broker-dealers had been repoed predominantly U.S. Treasury securities by LTCM, billions of dollars of them. In fact, in some cases, billions of dollars of the exact same security with the same CUSIP. Because none of those broker-dealers knew the other broker-dealers' positions or repo trades with LTCM, they couldn't have known that they might be selling the same securities, should LTCM have a problem, in vast quantities at the same time. Sure enough, when LTCM defaulted, we became aware of something called concentration risk, and we will discuss this in a later lesson. Let's say the 10-year note is very liquid and a trade of 500 million could easily trade, and not much would happen in the market. But if a broker-dealer had to sell 5 billion of the 10-year note, or there were rumors of other sellers behind them, the security could drop significantly in price. To make this worse, each broker-dealer thought of LTCM as one of its best clients, and it offered maybe its best repo rates, so a thin profit margin, as well as small initial margin, and we'll be talking about this a few times in the course. Maybe even only 0.1% initial margin. If the market could move a point or 2 points, that's 1% or 2%, the broker-dealer could take a large loss just on a U.S. Treasury security, just because of the size of the position being sold. This is why the Federal Reserve made an unprecedented move at the time and brought all 16 broker-dealers into a conference room. There, they described the problem and its enormity, since they knew all the positions, unlike each member. And the group worked out a solution to very slowly liquidate the positions, not in huge chunks, even to increase positions on other securities with LTCM that had higher initial margins, like 5%, so that the liquidation would be orderly and the group could control unwinding of LTCM by becoming its default manager. Boy, that one gave the repo market a lot to learn from. It also really put repo on the media's and public's radar. In the same year, but far overshadowed, began the lengthy legal process over Crimmy May, a REIT who was an issuer of guaranteed mortgages, commercial mortgages, and non-investment grade mortgages, which filed Chapter 11 bankruptcy because it couldn't meet its repo margin calls. We'll discuss this later. And argued that its 3-year reverse repos, also discussed later, were not actually repo transactions because they were beyond the normal 1-year purview of bankruptcy law and typical repos at the time. Eventually that was proven in the courts to be untrue, but it was a painful length of time for those lenders who were stuck holding and waiting with the bonds that had dropped in value. In the end, the court upheld that it was a repo transaction and all rights and remedies were available to the lenders. In 1999, an incident happened with repo and the Bank of Korea and bonds done with the Bank of Korea. It highlighted a kind of credit risk that the market hadn't anticipated, one of sort of doubling down on credit risk. Not only would the credit department of the broker-dealer look at the Bank of Korea as a repo counterparty, they also had to look at the bonds issued by them that they put up for repo. The assumed safety in theory of repo has always been that it is a two-step credit risk. One, you have collateral, and maybe even additional margin collateral, versus your providing of cash. Two, if there is a default on getting your cash back, you can sell the collateral and get your cash back. However, in this instance, the collateral had the same credit risk as the repo counterparty. If one defaulted, the other could default. Bank of Korea did nothing wrong, but broker-dealers realized they hadn't anticipated this additional risk, and they learned from it. Interestingly, this has come up at least a dozen times during my career, as clients ask me if I will take in commercial paper or CDs on repo. Typically, it is the CP or CDs that the counterparty has issued. Even if it is not, the type of CP they were showing me was not asset-backed, so it was just a general obligation of another bank. So in a sense, to me, it was doubling down on credit risk. Despite the market learning from this in 1999, this actually happened to a large money fund in 2007 who repoed in, inadvertently, commercial paper of a failing broker-dealer. That quickly bringing us to 2007 on this chart. As I said, this is going to be a short history. This was the height of the housing market, and at the time, the height of the bond, equity, and repo markets. In March, a series of events occurred that set in motion much of what we would see in the next 3 to 5 years. Leverage was high again, initial margin requirements were low again, collateral was complex and hard to price again, and there was difficulty discerning whether the counterparty was the broker-dealer or a subsidiary and where to price the securities for repo. Rather quickly on a Monday morning, Bear Stearns and Bear Stearns Asset Management became insolvent, setting off a string of problems and events for other companies and their lenders. Illiquid collateral on repo dropped dramatically in price, and losses mounted at other broker-dealers and cash providers. The Federal Reserve initially wasn't sure what to do, whether to let them fail or provide a taxpayer bailout. In the end, they allowed JP Morgan Chase to buy them out for a discounted price. But the alarm bell had been rung. Maybe 6 to 7 months later, another major broker-dealer, Lehman Brothers, was unable to meet its margin calls and became insolvent, setting off another wave of losses and panic on the street. This time it was more public, and this time it was larger. Also this time, Wall Street wasn't sure that the Fed would step in to bail them out or to negotiate a deal. In the end, the Fed did neither, or neither. This spawned the debate of too big to fail, which we will cover later in this course. Ramifications of Lehman failing were massive, and unlike Bear Stearns, more international. In fact, there was a bottleneck for weeks in London of billions of dollars of repo trades that couldn't settle. And I'll be explaining that particular thing coming up in another lesson. The ripple effect of Bear Stearns, Lehman, too much leverage, unpriceable liquid securities, low initial margins on repo, the housing crisis, which was now in full sway, a buying and flipping fever among the public that had straw man loans, undocumented loans becoming securities, poor disclosures, etc., led to a massive meltdown of the financial markets, which we called the financial crisis, which most people now call the Great Recession. No part of the financial markets or segments of the economy globally were untouched. The media wrung everything they could out of the crisis. Suddenly, repo was too well known by the public. I can't believe that I just summarized the greatest financial catastrophe of the world in one paragraph. But as I even talk about it, my gut churns and I taste metal in my mouth. And I know that I still haven't erased the memories of 2008 and being in the office on weekends and holidays, pricing securities and making margin calls that may not be met. It was awful for customers, for broker-dealers, for countries, and for the public. Once capital markets and securities financing caught the attention of the media, and therefore the public, it wasn't long before the legislators got involved and ordered the regulators to do more to make sure this didn't happen again. Now, don't get me wrong, I'm not blaming the repo market or securities financing market for what happened in the financial crisis. There were a lot of complexities of who did what, and who caused what, how much involved Wall Street, government, or the public. There was plenty of blame to go around. There have been many books spawned by the financial crisis, and you can read them to learn more about it and to form your own opinion. Let's just agree that it caused a public outcry, the 99%ers, who pressured their congressmen and senators to do something, and the legislators debated for a long time but came out with very strict regulations for the Federal Reserve and the newly formed Fsoc. I'm going to let you look that up in the acronym addendum, to execute and monitor. One of the first ones, which actually had been in the works behind the scenes from the Bank for International Settlements, BIS, was called Basel III, which would be a much broader and more stringent version of Basel I and Basel II, which I may be one of the few people to remember both. Basel II, in its many facets, dealt particularly with bank trading and financing practices internationally, and really reached an apex of debate and media attention in 2012. Let me correct myself, that's Basel III, not Basel II. We don't want to talk about Basel II anymore. We will delve into Basel III and now the new 2019 Basel IV later in Repo 101. Prior to Basel III, as I said, the legislators pressured the regulators in the U.S. to do something to protect the public against systemic risk and a repeat of the financial crisis. That took the form of a giant octopus of legislation called the Dodd-Frank Act, which had over 300 regulations embedded in it. Many of them were created in 2008 to 2010 and then rolled out and enforced. But also many were deployed later in 2012 to 2018 due to many delays, some begged for by the industry and some necessary for the regulators. In fact, some of the Dodd-Frank regulations have still not been implemented because of delays and debates. Again, books have been written about the act that itself was like a book. I wrote that 2014 major white paper, which was 70 pages, so that's like a book, on the impact of the major parts of that act on different segments of the securities financing market, like the pension funds, the money funds, securities lending agents, broker-dealers, REITs, etc., etc. We will address some of the major issues and the impacts on the repo market later in Repo 101 in that regulations section that I talked about. I don't want to get too bogged down in it now at the beginning. It is fair to say that the Dodd-Frank Act and to a lesser degree Basel III changed the securities financing market the most in my career, and probably in permanent ways. The implementation of several regulations wound up also having many unintended and unforeseen consequences, particularly on specific segments of the market. I would like to say that you are now up to date on the new regulations impacting the repo market, but there have actually been a few more this past year, passed or being discussed, including ESG, short sales, Basel IV, etc. But you know most of the stuff now, and we'll delve deeper into the previous regulations and into these new ones when the time is right in the course. Let's step back from the regulations themselves and talk about the regulators. The securities financing market, repo and securities lending, has a large number of regulations. It also has a large number of regulators. The regulators are our friends, mostly. It wasn't always that way. When I first started in 1982 as my predecessor, overnight repo trader, bolted out the door for the US Open, after teaching me for one morning never to return, there were not many regulators or regulations. But since several market-changing and world-changing financial incidents, which I've described to you, many more regulations have been created and many new regulators to monitor those regulations and protect against bad behavior. Now that I've rushed through the greatest hits, as it were, of repo, to give you all a historical context for the product and the regulations, I want to focus on two regulations in particular, because they are currently very important and still being debated. And we're going to talk about them again later, but just briefly later. First, we have to know the players, the regulators that are involved. Both organizations were started as the result of the financial crisis or Great Recession of 2008 to 2010 to combat systemic risk in the financial system. I say that again. To combat systemic risk in the financial system. The first, the Financial Stability Board, or FSB, is made up of the financial ministers of all nations in the G20. So it has a very international purview. The second, the Financial Stability Oversight Council, or FSOC, which I mentioned a couple minutes ago, was actually created by the Dodd-Frank Act in 2010 and is made up of all US-based regulators into a kind of super regulator, but with a purview of just the US, although they make suggestions to other regulators. The main components of the FSOC are the Secretary of the US Treasury, the Chairperson of the Federal Reserve, the Comptroller of the Currency, or OCC, but that's not Options Clearing Corporation, which we may touch on later. The head of the newly created Consumer Financial Protection Bureau, the head of the Securities Exchange Commission, the head of the Federal Deposit Insurance Corporation, which is the bank regulator, the head of the Commodity Futures Trading Commission, which is the futures regulator, the head of the Federal Housing Finance Agency, which is the regulator of the GSEs, or government-sponsored entities, the head of the National Credit Union Administration, and an insurance person appointed by the US President, and several other various advisors. Don't forget you have that Addendum 1 right after Lesson 11 that you can refer to now and throughout the course for help with an avalanche of acronyms coming your way. Wall Street loves its acronyms, and securities financing market is no exception. Slide to apologize for any slides that look like this. I have tried to make every slide as legible as possible and experimented with many styles, fonts, and animation to provide the best possible experience for you. Unfortunately, it's sometimes hard to cram 38 years of experience into a slide, and certain topics don't lend themselves to brevity. It is kind of a tangent already. I'm sure that you are shocked that you already have to deal with regulations. But it is relevant now to familiarize you with these regulations. Now that you see where they came from, those two regulators, and how they directly impact the repo market and you in the future. Unlike other regulations we'll explore as they come up along the course, these two have not been decided or implemented, so they're being debated. Both of the aforementioned super regulators, made up of many senior regulators, have been talking since the financial crisis about something called shadow banking. The use of the word shadow is to infer that the practice is somehow hidden in the shadows and needs light and regulation shown on it. Obviously, it has a negative connotation, that shadow banking is bad and the regulators are here to save the day, or at least save the public. The problem is that there were already at least two definitions of shadow banking out there before FSB and FSOC snatched it up, so that makes it even more confusing. I'm here to sort it out for you as best I can, but bear in mind that even after sorting out, I may disagree with its negative connotation. In China, there has long been, way before the financial crisis, a practice of banks and other financial institutions to lend money to other companies or private citizens off balance sheet, basically undisclosed. Chinese authorities have been cracking down on this part of the market, which they have referred to as shadow banking, for at least a decade. The newly formed FSOC announced that the decades-long practice of broker-dealers using special purpose vehicles, or SPVs, commercial paper conduits, and other bankruptcy remote structures to do their repo trading, and their use of two accounting rules, FINRA 41 and FASB 125, to net down repos on their balance sheets, were both ways the broker-dealers were not disclosing all of their repos on their balance sheets, and that this was shadow banking. Basically, it was trading not seen by investors and viewing the broker-dealers' balance sheets in their annual or quarterly reports. Remember that the FSOC was formed by the Dodd-Frank Act in 2010, so after the financial crisis, and was there to prevent systemic risks from happening again to the financial markets and to protect the public. I could see the first part, that those trades were clearly off balance sheet, but given their bankruptcy remoteness, I'm not sure how the investors in the banks would necessarily suffer in a default. The second part kind of baffles me, since the broker-dealers were simply using authorities' rules for accounting, and suddenly that was a bad thing. FINRA and FASB had created these rules for them. To be fair, though, the FSOC wanted to be able to accurately measure the repo market, and certainly couldn't with all of these variables. Point of fact, during my 38 years in the securities financing market, everyone from participants to regulators has had trouble measuring the size of the repo market. I have been one of the participants who has frequently taken on that task, once for the Office of Financial Reports, OFR, part of the U.S. Treasury, and some other regulators and participants have used my work. But still, there are too many variables in too many different countries and way too much double counting. Plus, the regulators themselves change the amount of repo they do to get a real precise number. But I will make an attempt for you in Lesson 5. Which leads in nicely to the FSB's third definition of shadow banking, the more elusive definition, like the Yeti or the abominable snowman. First, the FSB, unlike all that have tried before, announced in 2011, shadow banking has reached $67 trillion globally, pointing specifically at Lehman's downfall and the aftermath unwinding debacle of about $8 billion in repo trades in London. The FSB said shadow banking and repo must be stopped and regulated. How they came up with $67 trillion globally, I have no idea. since most people can't come up with how big the repo market is at all. It seems that in the broad FSB definition, shadow banking means any securities financing done through an intermediary that would then result in further securities financing of the same security. So, for instance, if Morgan Stanley repoed to Goldman Sachs and Goldman Sachs repoed to money fund Joe Smith, then that would create shadow banking because the same security had repoed from one party to a second party to a third party, kind of double counting it under the shadow banking description. The multiple repoing of a security has certainly been a commonplace part of securities financing for the decades I have been in the market and before. So even though these securities financing trades would likely be on the intermediaries, commonly the broker-dealers, balance sheets, and so disclosed, that was not enough disclosure for the FSB. The FSB resurrected the word counter-cyclicality to describe the historical pattern of securities being multiply financed even more times and more frequently in times of market distress or systemic risk. They're really bad in their eyes. Ironically, the product I was working on last, which could wind up disintermediating broker-dealers, taking them out of the middle, would have reduced this type of shadow banking. But I'm not sure I agree that this is a major cause of systemic risk. In a way, the recycling of securities gives liquidity to those who otherwise would not have had access to it, and it lubricates the money markets to enable governments to issue securities. In the example I gave, if this customer, this Joe Smith fund, was not a customer of Morgan Stanley, but was a customer of Goldman Sachs, it was able to get the securities it needed for its cash to be invested in from Goldman Sachs, which it wouldn't have been able to do had that intermediation, or now called shadow banking, occurred, that multiple repoing. Okay, that's enough about this ephemeral shadow banking and the threatened regulations, which have yet to be defined or issued. You won't hear a peep out of me about this particular subject until Repo 201. The second part that I wanted to talk about, as the waves receded from the Dodd-Frank Act in 2012 to 2014, having forever changed the coastline of the securities financing market, probably more so than any other industry, there was a rumble about public revenge. There was outrage still from the public towards Wall Street, incorrectly blaming Wall Street for all of the financial crisis, ignoring the role that the public had in the mortgage crisis and securities financing, which had bathed for decades in its anonymity, was now constantly battered in the press. Suddenly, friends who couldn't even remember my name knew that I was involved in repo and what repo was. Fancy that. I think, and remember, this course is informative, but also has some of my experiences and opinions, so sometimes it's like a memoir, that the EU heard the public's continued outrage and felt they needed to do something about it. The EU began socializing an idea of financial transaction tax among its member nations. This would not be focused only on securities financing, but broadly to other financial transactions as well. It's still not clear whether it would be a percentage of the amount transacted, like a tax, or a percentage of the profit earned, who would pay, the buyer or the seller, and which transactions would be covered and which ones exempt. Also, there hasn't been much discussion about where such financial transaction tax would go. Who would benefit? The investors hurt in 2007 and 2008? The general public? Or the governments? In its simple definition, an additional tax on a thin margin market like repo, which is currently trading near 0% and in some countries trading negative percentages, which has seen a massive decrease in size due to hundreds of regulations designed specifically to delever it, would likely lead to additional shrinkage of the market. And it's interesting that just last week, this topic has come up in New Jersey, as the New Jersey governor is now talking about implementing a financial transaction tax there. And it happens to be where several of the Wall Street firms who have moved out of New York City, perhaps because of tax reasons or because of the remote status of many of their employees due to COVID-19, now reside in New Jersey. So that will be interesting to follow. Regulations can be a difficult part of securities financing. You now see why some of them have been enacted and the trouble the market can get into without some of them. There is a general feeling in the market, particularly among broker-dealers, that there is too much regulation. And for years, when the regulation panel came up in industry conferences, many people avoided it. It was a mistake to put it after lunch or at the end of a conference because nobody would be in attendance. So let's leave regulations for a while and focus on the guts of repo, the nomenclature. You may think the trade strategies or the regulations are the most complex parts of repo, but that is not the case. It's the language and the acronyms. I've boiled down everything you will hear on a trading floor or phone to the most important items. First of all, repo is a misnomer. It has been oversimplified and used as the generic word for securities financing by many people, even long-term participants in the securities financing market and the media. As we discussed, repo means a repurchase agreement, which simply means that I agree to sell you this collateral at this principal amount, price adjusted for haircut, and I agree to buy it back from you at a future agreed upon date at a higher price, which reflects an interest rate on the cash you gave me at the beginning and which I now return to you. I know, looks like an easy sentence to me after 38 years, but you're scratching your head. Let's focus on the interest rate. For this discussion, let's think of it as an interest rate on money loaned to me for the collateral I gave you. That is not what the legal agreement between us says, which unfortunately is also called a repurchase agreement, just to make things more confusing. And it is not the way these securities transactions are viewed by the courts and the regulators, as you know already from the history of repo that I just gave you. Those landmark cases shaped repo law and repo agreements and documents. So a repo rate is an interest rate. It is also referred by many as a price, because the repurchase agreement document refers to that principal amount at the beginning of the trade as the purchase price, what I sold the collateral to you for. As a yield, it's also known as a yield, also known as a level, also known as a rebate or a reinvestment rate. If you look at bond yields, which are interest rates of any bonds, they are in inverse relationship to prices. As you may see in bond courses offered by Finance Academy, when bond yields go down, bond prices go up, and vice versa, inverse relationship. That is the most important thing to learn about repo. When the repo rate, interest rate, yield, whichever you prefer, goes down, the repo is more expensive or rallying. If the repo rate, interest rate, yield goes up, the repo is cheaper or falling. If I repo this collateral to you at some price for some interest rate or repo rate, I don't want to see the repo rate go down in the market, or I have repoed it to you too high. Or I want to have a reverse repo on the books, getting that collateral in from someone else at a higher reverse repo rate than the repo rate I gave to you. This is the most important concept of repo, so let's make sure that we all understand this. If it helps, think of interest rates on loans. I give you collateral and agree to pay you 1% on a loan for 3 months. If the next day I see in the market that loans for the same period are now going for an interest rate of 0.75%, I won't be very happy. But if I reverse repo that same collateral that I gave you, I gave a loan of about the same amount of money for an interest rate of 1.50%, I won't be as unhappy because I am theoretically making 0.50% interest for 3 months on the two transactions paired together. Reverse repo should be higher, repo should be lower, and the spread between the two is theoretically my profit. So if the market goes down after I repo the collateral to you and receive money, then prices have gone down and interest rate yields have gone higher. And I am happy because I locked in a lower interest rate or yield. You'll hear much more about this in the coming lessons. So I'm going to make it second nature to you. It must be second nature for you to survive in this sector of the market. Okay, so I still feel like I glossed over this, but you probably know what I'm trying to convey. A repo is a sale of securities. Securities out, money in, and you owe interest. A reverse repo is the opposite. A buy of securities, securities in, money out, and you receive interest. But let's remember the inverse relationship between prices and yields again right now. With a bond trade, any kind of bond anywhere in the world, or a stock trade, any kind of stock anywhere in the world, you are selling at a price and you want to get the highest price you can. But a repo, even though it may be called a sale, is the opposite because it is based on yield or interest rate. So you want to sell a stock at the highest price, but you want to repo a stock at the lowest repo rate, yield, or interest rate. Some of you are rolling your eyes, I see it in the back, feeling that you've already got this down and I should move on. But I have traders working for me who have, in the past, in the blink of an eye, forgotten the relationship between yield and price and repoed securities at the wrong rate or reverse repoed securities at too low a rate, and has been on huge trades of hundreds of millions of euros or dollars, and it is a real loss to the firm. It is not normal to the way the rest of Wall Street views the market, and it is hard nomenclature to make second nature, but you absolutely must. Those traders never made that mistake twice. I remember one trader who didn't know fractions. I had him trading overnights, and he's arguing with a customer that he offered securities to at 3/8, 5 3/8%, I think at the time, and the customer was saying 5 1/4, and he said, "No, I want 5 3/8." And he was actually arguing with the customer for a higher rate of interest to pay that cash providing customer. So he never made that mistake twice. That reminds me, the securities financing market has, since I started, been sort of a club. I don't mean that as a sexist comment in any way. Members move around to different firms during their careers, male or female. I was one of the minority to move to only 3 firms during my career. Most probably on average are 5 to 7 firms. But the membership itself doesn't change much. So many people know each other for years or decades. Many repo traders and salespeople and middle office folks have known each other for years. They develop a camaraderie, not unlike college fraternities and sororities, and they have their own language and their own jokes. Over the years, on a trading desk or in a sales group, you will hear all the most famous lines of all the greatest movies with a bent towards comedies and gangster movies, and likely the same 100 jokes. But along with that, which don't get me wrong, is great, forget about it, there is this shorthand nomenclature of the trading and the selling of repo that is part of that, kinship. People get comfortable asking for bids, collateral coming in, but a reverse repo, not an outright. Offers, collateral going out, but a repo, not an outright. Borrows, which is a securities lending term equivalent in direction to a reverse repo. Lends, which is a securities lending term equivalent in direction to a repo. Reinvest, which is a securities lending term equivalent in direction to a repo and actually using a repo. etc. The folks on a repo trading desk, securities financing desk, will get into the habit of referring to pizza as bathrooms as the John, phone banks as turrets, trades not executed but still potentials as subject, 100 million trades as twigs or branches, and 1 billion trades as logs, etc. I can't even remember them all, and the list would be too long. That's all well and good to form a tight-knit group, but it doesn't help the new folks like you, I'm assuming. It also can lead to catastrophic mistakes. When a trader or salesperson says they did 5 logs at such and such rate for such and such term, and the trade is done. But they thought logs were 100 million each, and the trader thought they were 1 billion each. Now we have a serious problem. Frankly, as I told my people at 3 different firms divisions, err on the side of clarity. Even if the other person says, all right already, I got it. You don't want to be stuck with a trade that was a misunderstanding or a deliberate pickoff, borrowing from American baseball, I think. I have had to work through misunderstandings during my career, of course, but I have been stuck I've been stuck only one time, and it was a pickoff. When the Fed tightened, which means they raised interest rates, you're going to know plenty about the Fed later, and the broker screen did not go subject. You can tell it's still upsetting me. And the broker screen did not go subject as it should. I stood for the large trade, which was the honorable thing to do. I did not attack the broker, and karma actually bailed me out because the other broker-dealer did not have nearly enough collateral to fill the trade to me. So he failed over a weekend of 3 days. Oddly, my firm actually made a chunk of money on the pickoff rather than the other trader. But there was a famous example of a multi-billion-dollar trade that occurred in which the broker-dealer wasn't let out of the trade and made a handle error. The going repo rates at the time were about 3%, and they accidentally quoted 2%. And we're done on a huge reverse repo. The amount was so large that it appeared as a quarterly loss for the broker-dealer and a quarterly gain for the counterparty. Nomenclature and club language is one thing, but we deal in huge numbers, and mistakes can be huge. It is easy to lose that perspective. When you go home and you balance your checkbook, you're dealing with much smaller numbers than you're flipping around seconds at a time in repo. I have been managing repo desks in charge of hundreds of billions of dollars in repo match books, portfolios, if you will, much larger than most outright desks, and sometimes with repo trades that were 30 years long, like a long bond. Enough scary stuff. I just talked about bid and offer as it relates to repo. It is, again, bid for taking in collateral on reverse repo and offer on putting out collateral on repo. It is from the perspective of the direction of the collateral. Many people in our industry screw that up. Even the regulators refer to it the opposite way, as we will see. It is a problem in our industry that can lead to much bigger problems. I frequently see issuers ask for a bid, but they are actually issuing bonds and taking that cash and investing in repo, so they really want an offer of repo. The Fed's RP program is not them actually repoing collateral, like an RP, but instead reverse repoing collateral from primary dealers. And on the other hand, their reverse repo program, which is very popular right now, is not them actually reverse repoing collateral from cash providers, but actually repoing collateral to them. So they've got it completely backwards. Even if others don't say it right or get it straight, you still need to follow the collateral and who gets it. If you get the collateral, it's a reverse repo. If you're giving out collateral, it's a repo. As I approach the end of lesson 1, let's look at bid and offer together. You'll hear many people speak of the bid-offer spread in the repo market. This is generally the average reverse repo rate bid minus the average repo rate offer, since reverse repo rates are usually higher than repo rates. Remember that these are bid-offer yields or interest rates, not bid-offer prices like on bonds or stocks, as we talked about. Bid-offer spreads in repo, again, I'm using the term generically throughout. I'm saying repo, but you know I'm talking about securities financing or repo and reverse repo. It's just a lot more to say. Depend greatly on the collateral involved. Some collateral is more liquid, like fan briefs or treasury bills, and the bid-offer spread will be narrow. Some collateral is less liquid, like whole loans, and the bid-offer spread will be much wider. That could be based on many factors, even how many market makers there are for that particular collateral. On the outright side, how many bidders and offers. Another important factor for the bid-offer spread is the term or tenor of the trade. Not exactly sure why they use tenor, but it's interesting. I was a tenor once. I guess I'm now a baritone. I used to be a soprano, but let's not go there. That tenor in this particular case does not mean me. It means whether it is an overnight, a 1 month, or maybe a 2-year trade. How long the transaction, coupled with what kind of collateral is involved, can have huge impact on the bid-offer spread. We'll get into this much deeper later, but let me leave you with one last thought. The source of the data is critical to determine if the bid-offer spread is correct, including what is the sample size. And if you are looking at the mid-rate, the median rate, the average rate, the weighted average rate, etc., those could be completely different numbers. Just a thought to leave in your head. So now I have the pleasure of summarizing this first lecture in lesson 1. So we talked about me much more than I would have liked. We talked about the history of repo, and I did it really fast. I know it didn't seem like it was really fast because there were 2 slides involved and an awful lot of issues, but it's been a long time, and there were a lot of smaller issues that I didn't even bring up. We talked about the regulators. We talked about 2 specific regulations. We got really into the nomenclature and definitions, which will be the backbone of what you're dealing with for the rest of your career, probably. And we talked about the sources of information, which is really important. So hopefully I'll see you in lesson 2. Lesson 2 is going to dive into the Repo Basics. So the 4-letter word repo, exactly what constitutes a repo, what the life cycle of a repo trade is, what things you need to watch out for in repo, everything repo possible. Remember, the lesson after that is reverse repo. So we're going to be talking just about one side of this securities financing segment of repo and reverse repo, which is, let's say, kissing cousins to the other side, which is securities lending or borrow and bond lending. Thank you.